Mahindra & Mahindra has a debt to equity ratio of 1.44. If you follow my channel, you know I usually avoid companies with debt to equity of more than 0.25. So naturally, one of our community members asked, Santhosh, are you breaking your own rule? And honestly, this is one of the best questions I have recently received. Because after analyzing hundreds of companies, I realized that debt to equity ratio is one of the most misunderstood ratio in investing. If you use it incorrectly, you won't just avoid bad companies, you will also miss out some of the best opportunities in the market. And that can cost you far more money than you expect. For example, if the debt to equity above 1 is bad, then why do companies like Bajaj Finance, HDFC Bank and many successful business show high debt to equity ratio? Are the business are bad? Obviously not, right? So what are we missing here? In this video, I'll explain what debt to equity ratio actually means, why it should be used differently across different industries, why Mahindra & Mahindra shows 1.44 of debt to equity ratio. I'll also take a look at net debt because our goal is simple, to become a practical investor, not the textbook investor. And I would like to remind the purpose of this channel to make the ordinary people into extraordinary investors. Let's get started with the textbook definition of debt to equity ratio. Debt on the numerator and equity sitting on the denominator. The debt to equity ratio is a division of debt on top and equity on bottom. But what is debt? What is equity? We will see. See, debt usually consists of short-term borrowing, long-term borrowing and lease liability, and equity is equity capital and reserves and surplus. Quickly we'll see what is short-term, long-term and lease. Short-term basically means the debt due soon, within 1 year, which means paying supplier, operating expense, such kind of debts. And long-term is debt due later, more than 1 year. For example, buying buildings, funding major growth, those kind of expenses. Or lease is renting a big asset, for example office space for IT infrastructure or flights for Indigo, such kind of companies. It can be anything which actually accounts for regular payments or obligation. See, again, we don't own it, but we are obliged to pay. So debt to equity is actually the total debt divided by shareholders equity. We saw what total debt is and shareholder equity is. In simple terms, this ratio means what is the debt with respect to what is the shareholder fund. Lower the ratio, better for the company. This is just a theory, but investing is not about theory alone. The real question is, how do we use this ratio practically? Suppose I blindly apply my rule. I will never invest in companies with debt to equity ratio above 0.25. Sounds safe, right? But let's test it. When we screen companies with debt to equity above 1, we find names like Bajaj Finance, HDFC Bank, ICICI Bank, Axis Bank, many banking and non-banking. Okay, many leading NBFC and banks are coming. Now think about it. If we eliminate all these companies simply because of ratio, we might miss some of the India's strongest business. So what's happening here? The answer is simple. The ratio must always be interpreted in the context of business. Banks and NBFC are different. Their business model itself is built around borrowing and lending. They borrow the money from one rate, they lend it at higher rate, and the difference becomes their profit. Therefore, higher debt is not necessarily a danger signal for banks and NBFCs. It's actually part of their business model. This is why applying debt to equity ratio to financial companies the same way we apply it to manufacturing companies can be misleading. This is the first practical lesson that I have learned. Understand the business before judging the ratio. Now, let's come back to the original question. Mahindra & Mahindra shows a debt to equity ratio of approximately 1.44. At a glance, that looks very high, right? But let's dig a little deeper. Going back to Mahindra & Mahindra in the screener, the debt to equity is 1.44, which is not at all acceptable. And what is causing this 1.44? So equity is 559 plus 92,538 and the borrowing is 1,33,963. Even the cash equivalent is actually not accommodating with that, which is 31,979. But one more thing we have to understand, this actually is the view of consolidated figures. We are seeing the consolidated figures, not the standalone. See, in eye level, every time we used to see the consolidated figures because it gives the overall consolidation of the company fully. But in some cases, to decide what is actually going under the roof, within 1.44 of debt to equity ratio, we need to understand the standalone segment. When you press standalone segment, then suddenly the balance sheet actually speaks a different language. 601, 734 and only borrowing is 1653. So the point is, if you go to standalone and go to the M&M dashboard, the debt to equity ratio is 0.02, and the same way if you come to consolidated and go to the debt to equity ratio, it is 1.44. So what is happening between standalone and consolidated? When you view Mahindra and Mahindra consolidated financial statements, all group business are included. One of those business is Mahindra's Finance. Mahindra Finance is an NBFC. Its business involves, like as I said earlier, lending money. Naturally, the business carries higher debt. As a result, the consolidated debt to equity ratio appears to be much higher. Now watch what happens. When we switch from consolidated to standalone numbers, the debt to equity ratio drops dramatically. In many cases, it becomes very less. That's huge difference. Consolidated consolidates all the business groups, but standalone gives you the result of only the manufacturing of cars, tractors, that segment of the business. And one more thing to be added is Mahindra is having a finance lever in the same business where they are into lending business for giving loans to tractors, whoever purchases car. So that lending business, if it is integrated, then it will actually shoot up the debt to equity ratio to 1.44. And if that is removed by choosing the standalone, the debt itself goes to 1653. Hope you understand now why that impact is coming. And going back to our previous example, NBFC, banks, debt to equity ratio is not the right ratio to compare and take decision. So putting together pieces, putting the puzzle together, now you understand why Mahindra and Mahindra is 1.44 debt to equity ratio, but still I am watching it in my watch list. Same way, let me take another example of TVS. TVS company is also an automobile company where the debt to equity ratio is 3.43. But again, when you go to balance sheet, the debt says 32,791. But if you press standalone, the debt says 3,733. So when you go to TVS Motor, it is 0.33, net debt to equity is 0.25. Again, the reason lies in the group structure and subsidiary business. This is why blindly rejecting companies based on single ratio can be very dangerous. So the key lesson is not all the debt is equal. You must understand where the debt is coming from. Personally, I also look at another metric, net debt to equity ratio. Why? Because companies may have debt, but they may have also substantial cash reserves in their hand. Let's use a simple example. Suppose you have a loan of 10 lakh rupees for your any of the purpose. You also have a fixed deposit of 5 lakhs in your bank account. Are you really carrying 10 lakh of debt? Not exactly, right? Your effective debt exposure is close to 5 lakhs. The same logic applies to companies also. A company with high debt and large cash reserves is very different from a company with high debt and no cash. That's why net debt often gives a clear picture. And how to calculate net debt? Let us take an example of TCS and see. For example, if you go to TCS, the debt to equity ratio is 0.11, negligible debt, but still we will understand the concept. How the debt is calculated is, go to balance sheet, as I said, equity capital 362 plus 1,06,878 is a reserve, put together it becomes equity, and borrowing is already summed up 11,283. If you divide this and the equity, it will come as 0.11. But if you go to the cash component in other asset, actually the cash equivalent, if you see the cash equivalent, it is itself 12,908, which is your 5 lakh which is sitting in FD. That is equivalent to this cash equivalent. So when the borrowing is 11,283 and the cash equivalent itself 12,908, that's how the net debt to equity comes around minus 0.02. If you don't know how to get this net debt to equity, go to edit ratio and actually come down and create a new ratio. In this new ratio, debt to equity, if you go, this is a formula. You can pass and recreate the same thing so that you will get the net debt to equity ratio in your home screen. Hope this is clear for you. For example, the same way, if you go to any other company, Reliance. So Reliance Industry has 0.45 as a debt to equity ratio, 0.28 as a net debt to equity ratio. Go to the balance sheet and understand this is equity, this is reserves, put together becomes a shareholder fund, and borrowing is 4,02,000. And if you actually negate the cash equivalent, which is 1.45 lakh, then you will get the net debt to equity of 0.28, which is okay, below maximum threshold of 0.3 for me, for the largest company like Reliance. Hope you would have understood the net debt to equity concept. If you have still any questions, please put it in the comment section. I will be happy to explain that. If you are finding value till now, please like, share, subscribe to this channel to get the practical understanding of the market. Because if you want theory part, there are n number of resources available in the internet. You can go and learn, but how to use it practically, how to take decision in stock market with the practical knowledge, that cannot be taught by the books or any YouTube videos. I run personalized sessions for my friends and families, and right now I am extending to the YouTube community. If you are interested, if you are finding value from this channel, consider going through the website. Link is in the description. You can go through it. Already you can actually have access of videos, what do we do in the community, and you have also the access of people who are actually part of the community for months together, what they are feeling, and you can understand whether this is a good fit or not. To get more details, consider joining the community and decide yourself. Going back to net debt to equity, first we saw debt to equity ratio, what is debt to equity ratio and how it is used, and then we saw like what are the practical use cases, why it should not be applied in banking, and we saw what is the use of net debt to equity ratio also. And if you are sticking to this video till now, I appreciate your seriousness towards understanding the stock market practically and implement it. So I wanted to give you another concept which most of the investor will overlook, that is lease liability. A few years ago, companies used to treat many lease expenses as operating expense, but accounting standard changed in around 2019 or 20. Now, long-term lease commitment must be recorded on the balance sheet. This means many companies suddenly started showing higher debt, not because they borrowed more, but because accounting rules changed. For example, a company leasing office space for several years now records the future commitment as a liability. This increases debt to equity ratio. But not all the lease liabilities carry the same risk. For example, TCS leasing office buildings is very different from airline leasing aircraft. An airline cannot run its business without aircraft leases. Therefore, the risk profile is completely different. Again, context matters. This brings us to the most important lesson. Successful investing is not about memorizing the ratios. It's about understanding business along with the ratio. A ratio is always a starting point, not the final decision. Think about this. An engineer may understand every part of truck engine, but a truck driver with 20 years of driving experience understands how to handle it in the real roads. Investing is similar. Theory is important, but practical interpretation is where money is made. And this practical understanding is exactly what we focus on inside our learning community. Every Sunday, we discuss the 52-week high-low strategy, another advanced strategy that I teach to the serious learners in Sunday introduction sessions, real stock analysis, practical implementation, and on alternate Sundays we conduct dedicated doubt clearing sessions, because knowing a strategy is one thing, implementing it successfully is another one. If you're interested, surf through the community, understand what it does, link is in the description, and join the community to get more understanding of how we can practically approach the stock market with this community. I hope this video helped you understand debt to equity ratio from both theoretical and practical perspective. If you have found value in this video, like the video, subscribe to the channel, share it with your friends, and let me know your questions in the comment section. I'll be happy to answer. Remember, our mission is simple: to help ordinary people become an extraordinary investor. Thank you for your time. Thank you for your patience. Happy investing.